Right now, at this very moment, while you are watching this video, there are millions of Americans sitting at kitchen tables, opening envelopes from the IRS, writing checks they never should have had to write. These are retirees, people who worked 30, 40, sometimes 50 years of their lives, people who paid into Social Security from their very first paycheck as a teenager, bagging groceries or flipping burgers, people who sacrificed vacations, delayed gratifications, drove old cars, skipped dinners out, all so they could have something when the working years were finally over. And now that they have reached the finish line, now that they are finally collecting what was promised to them, the IRS shows up one more time with its hand out. And what is absolutely jaw-dropping, what makes this story so incredible that most people simply do not believe it when they first hear it, is that the majority of those checks being written are completely 100% unnecessary. The people writing them have been making the same quiet, invisible, devastating financial mistake year after year, and nobody in their life has ever sat them down and explained how to stop. According to the most current data available, approximately 88% of Social Security beneficiaries in America today are either paying zero federal income tax on their benefits or are legally positioned to get there with the right strategy. That is not a typo, 88%. And the 12% who are still cutting those checks to the IRS every single year, they are not paying more because they are richer. They are not paying more because the law says they have to. They are paying more because they simply do not know what they do not know. Today, that changes. Today, I am going to walk you through exactly what the IRS confirmed, what the law actually says, why most retirees never hear about this from their accountant, how the 88% are doing it, and what you can do starting right now to make sure you are never in that 12% again. Stay with me, because by the end of this video, you are going to understand your retirement taxes better than most people who call themselves financial professionals. This is not theory, this is not opinion, this is the actual tax code, and it is on your side if you know how to use it. Let me take you back to 1983, because that is where this entire story starts, and understanding where it started is the only way to understand how broken the current system is and why that brokenness actually works in your favor today. In 1983, Social Security was in a genuine crisis, the trust fund was nearly empty, the program was weeks away from not being able to pay benefits. Congress convened an emergency commission, and they came up with a plan. Part of that plan was something that had never existed before in the history of the program, a tax on Social Security benefits. Now here is what you need to understand about how that tax was designed. The lawmakers who wrote it set income thresholds for when the tax would kick in. If you were a single retiree and your combined income, which is a specific IRS calculation we are going to break down in detail, was below $25,000, you paid zero tax on your Social Security. If you were married filing jointly and your combined income was below $32,000, same thing, zero tax. The lawmakers who designed this said at the time that these thresholds were meant to protect lower and middle income retirees, that only the wealthy would ever pay taxes on Social Security. And in 1983, that was roughly true. The problem, and this is the scandal that nobody in Washington wants to talk about, is that those thresholds have never been adjusted for inflation, not once. Not in 1990, not in 2000, not in 2010, not in 2020. The $25,000 threshold for single filers that was set in 1983 is still $25,000 today in 2026. If that threshold had simply kept pace with inflation since 1983, it would be somewhere around $75,000 right now. Instead, it stayed frozen at $25,000, which means that every single year, as Social Security benefits got their cost of living adjustments, as interest rates on savings accounts moved, as pensions paid out their annual amounts, more and more retirees quietly crossed that threshold and started paying a tax that the people who designed the system never intended for them to pay. Back when these rules were created, fewer than 10% of Social Security recipients owed any tax at all. Today, the number has crept up to nearly 56% of all recipients owing some tax on their benefits. That is the result of 40 years of frozen thresholds in an inflating economy. But here's where it gets interesting. Here's where the story turns from a frustrating history lesson into something genuinely powerful that you can use. Because understanding the threshold is understanding the game. And once you understand the game, you can learn how to win it. So let's talk about the actual mechanics, because this is where most people's eyes glaze over and they miss the most important information of their financial lives. The IRS does not simply look at your Social Security check and decide whether to tax it. The process is more nuanced than that, and the nuance is exactly where your opportunity lives. The IRS uses something called combined income, sometimes also referred to as provisional income, to determine how much of your Social Security benefit becomes taxable. Here's the formula, and I want you to write this down. Combined income equals your adjusted gross income, not counting Social Security, plus any non-taxable interest you earned, plus 50% of your Social Security benefits. That is the number the IRS cares about. Now here's what happens depending on where your combined income lands. If you are a single filer and your combined income is below $25,000, congratulations. 0% of your Social Security is taxable. If your combined income falls between $25,000 and $34,000, then up to 50% of your benefits can become taxable income. And if your combined income exceeds $34,000 as a single filer, then up to 85% of your benefits can be included in your taxable income. For married couples filing jointly, the lower threshold is $32,000 and the upper threshold is $44,000. Now, before you panic about the 85% number, I need to explain something that trips up almost every retiree I have ever talked to about this. 85% taxable does not mean an 85% tax rate. Those are two completely different things. It means that 85 cents of every dollar of your Social Security benefit gets added to your other income and then gets taxed at whatever your normal marginal rate is, which for most retirees is 10 or 12%. So even in the worst case scenario, most average retirees are not losing anywhere near 85% of their benefits. They might be losing 10 or 12% of 85%, which works out to somewhere between 8 and 10 cents on the dollar. That said, even that amount is completely unnecessary for the vast majority of retirees, and here is exactly why. Now we are getting to the heart of it. Now we are getting to the part that changes things. Because the entire key to paying zero tax on your Social Security, the entire strategy that 88% of beneficiaries either use or are positioned to use, comes down to one thing: controlling your combined income. And the remarkable thing is that combined income is not like your salary at a job, where you either earn it or you do not. Combined income is a number you can actively manage, shape, and in many cases dramatically reduce through perfectly legal strategies that the IRS literally built into the tax code. The first and most powerful strategy is the Roth IRA conversion window. And if you are between the ages of 60 and 72 right now, and you have not yet started claiming Social Security, you may be sitting in what financial planners are calling the single most valuable tax planning window of your entire life. Here is why. Once you retire, and before you start claiming Social Security, your income often drops to its lowest point in decades. You are not working, you have not filed for benefits yet. Your traditional IRA is sitting there, but you do not have to touch it yet. Your taxable income in those years might be close to zero. This is the window. This is when you take money from your traditional IRA, pay a small amount of tax on it now at a very low rate, and move it into a Roth IRA where it will grow completely tax-free forever and where withdrawals in the future will never count toward your combined income calculation. Think about what that means in practical terms. If you have $200,000 in a traditional IRA and you convert it to a Roth over 5 or 6 years during your early retirement window, those future Roth withdrawals are invisible to the IRS's combined income formula. They do not push you above the threshold. They do not trigger taxes on your Social Security. The money grows tax-free, comes out tax-free, and never touches your Social Security tax calculation. This strategy is not new, but what is new, what the IRS confirmed, and what Congress just made official is that 2026, 2027, and 2028 represent an unusually powerful window to execute it, for reasons I'm about to explain. The One Big Beautiful Bill Act. That is its actual name, believe it or not. Signed into law on July 4th, 2025, this piece of legislation changed the retirement tax landscape in ways that most Americans have still not fully processed. And one of the most significant changes it made was the introduction of what is being called the senior bonus deduction. Here's what it does. If you are 65 years old or older, the new law gives you an additional $6,000 deduction on top of your already existing standard deduction. If you are married and filing jointly and both spouses are 65 or older, that number doubles to $12,000. This deduction is available for tax years 2025 through 2028, after which it is currently scheduled to expire. Now think about what this means in real numbers. A married couple who are both 65 or older in 2026 already had access to a standard deduction of $31,500. Add in the existing extra senior deductions that have been on the books for years, add in the new $12,000 bonus deduction from the One Big Beautiful Bill Act, and you end up with a situation where that couple can shield somewhere in the neighborhood of $46,000 or more of income from federal taxation before they even start talking about strategies. And here's where it connects directly back to the 88% number. According to tax analysts who have run the projections, the combination of the existing income thresholds and the new senior bonus deduction means that roughly 88% of Social Security beneficiaries, those who qualify for the deduction and whose incomes fall within the eligibility range, can structure their retirement income so that they owe zero federal income tax on their Social Security benefits. Not reduced tax, not a smaller bill, zero. The window is open right now, and it closes in 2028. But let's talk about the people for whom income management is not as simple, because not every retiree is in the low combined income category, and some of you watching this have pensions, have rental income, have traditional IRA required minimum distributions coming, and you are wondering whether any of this applies to you. The answer is yes, but the strategy looks different. For retirees with higher income streams, the game becomes about managing the sources and timing of income rather than simply reducing its total. One of the most powerful tools available is something called a Qualified Charitable Distribution, or QCD. Here's how it works. If you are 70 and a half years old or older, the IRS allows you to donate up to $100,000 per year directly from your IRA to a qualifying charity. When you do this, the money counts toward your required minimum distribution, meaning you satisfy your RMD obligation for the year, but the money never actually lands in your income. It goes straight from your IRA to the charity, and because it never appears as income on your tax return, it never gets added to your combined income calculation. This is not just a tax deduction. Deductions reduce your taxable income after it has already been counted. A QCD prevents the income from being counted at all. For a retiree who is charitably inclined, even modestly, this strategy can single-handedly keep combined income below the taxable threshold. Someone taking a $20,000 RMD who makes a $20,000 QCD to their church or their favorite nonprofit has, from the IRS's perspective, zero additional income that year. Their Social Security remains completely untaxed. They gave to charity, they satisfied their legal obligation to the IRS, and they owe nothing on their benefits. This is not a gray area. This is not an aggressive tax position. This is written directly into the Internal Revenue Code, and it has been available since 2006. Now let's talk about something that almost nobody mentions when they discuss Social Security taxes, and that is the 0% capital gains bracket. This is what one financial planning firm recently called the legal loophole most retirees do not know exists. Here is the situation. Most people know about ordinary income tax rates, the brackets that apply to wages, pensions, and IRA distributions. But investment income, specifically qualified dividends and long-term capital gains from assets held for more than a year, is taxed on a completely separate rate schedule. And in 2026, if you are married filing jointly and your taxable income stays below $98,900, your federal tax rate on those long-term capital gains and qualified dividends is exactly 0%. Nothing. But here is the part that catches people off guard. Taxable income in the IRS's definition means income after deductions, not gross income. So a married couple who are both 65 and older in 2026 can layer their standard deduction, their existing senior deductions, and their new $6,000 bonus deduction on top of that $98,900 threshold. When you stack all those deductions, a couple who is 65 or older can potentially receive somewhere north of $140,000 in investment income from dividends and long-term capital gains and owe zero federal income tax. Zero. Add in carefully timed Social Security benefits and Roth withdrawals, and you have the blueprint for a retirement income strategy that generates genuine six-figure income with a federal tax bill of nothing. This is why financial advisors who specialize in retirement planning say that the years between when you stop working and when your required minimum distributions begin are, and I am quoting directly here, the single most valuable tax planning window of your life. Here's something else the IRS confirmed that affects a huge portion of retirees and that almost nobody is talking about in plain English. The Social Security Fairness Act, which was signed into law and which began affecting benefit payments in early 2025, repealed two rules called the Windfall Elimination Provision and the Government Pension Offset. If those terms mean nothing to you, here's what they actually mean. Millions of Americans who spent their careers as teachers, firefighters, police officers, and other public employees were receiving reduced Social Security benefits because of these two rules. The rules were designed to prevent double dipping, but in practice they often slashed benefits for people who had paid into both Social Security and a public pension over the course of their careers. The repeal of these provisions means that many of those retirees are now receiving higher monthly benefits. Some are receiving retroactive lump sum payments for the months where their benefits were improperly reduced. And this is where the tax story gets complicated for this group specifically, because a large lump sum payment showing up in a single tax year can temporarily spike your combined income and push you into taxable territory, even if your normal year-to-year income would keep you below the threshold. If you are in this group, if you received a retroactive payment because of the Social Security Fairness Act, you need to know that there are provisions in the tax code for spreading the tax impact of lump sum Social Security payments across multiple years using something called the lump sum election method. This can significantly reduce or even eliminate the tax hit from that one-time payment. Your accountant may not have brought this up. Your tax software may not have flagged it, but it exists, and for some retirees, it can mean the difference between a massive unexpected tax bill and owing nothing at all. Let's talk about states, because the federal picture is only part of the story, and for many retirees, the state picture matters just as much or more. When people talk about Social Security taxes, they usually mean federal taxes. But 41 states and the District of Columbia do not tax Social Security benefits at all. And of the 9 states that do still tax benefits, most have income-based exemptions that effectively zero out the tax for lower and middle income retirees. West Virginia, for example, completely phased out its tax on Social Security benefits in 2026. That is a state where, if you were paying state tax on your benefits last year, you are not paying it anymore and may not even know it. For retirees in states that do still tax Social Security, the calculus of where to live in retirement becomes a genuine financial decision worth putting real numbers on. A retiree moving from a high-tax state like Connecticut, which does still tax Social Security for higher-income residents, to a state like Florida, Texas, or Nevada, which have no state income tax at all, can save thousands of dollars per year. Over a 20-year retirement, that is tens of thousands of dollars that stays in your pocket instead of going to a state government. And when you layer that state tax elimination on top of the federal strategies we have been discussing, the zero tax retirement is not just achievable, it is the expected outcome for anyone who plans deliberately and makes informed decisions about where and how they structure their income. Here is where I want to bring everything together and give you a clear picture of what the path forward actually looks like, because all of this information is worthless if you cannot turn it into a specific plan of action. The 88% of retirees who are paying zero tax on their Social Security did not get there by accident. They got there through some combination of the strategies we have discussed today, whether they knew they were executing a strategy or whether they simply happened to fall into circumstances that kept their combined income below the threshold. But for the 12% who are still paying, and for everyone who has not yet retired and wants to set themselves up correctly, the roadmap is clear. Step 1 is understanding your combined income number right now, today. Take your adjusted gross income, add any tax-exempt interest, add 50% of your current or projected Social Security benefit, and compare that number to the thresholds. If you are already below $25,000 as a single or $32,000 as a married couple, your benefits are already tax-free, and you need to make sure you take steps to keep them that way as your income changes over time. If you are above those thresholds, you need to identify which income sources are pushing you over and whether those sources can be restructured, delayed, or converted. Step 2 is taking the Roth conversion window seriously if you are between 60 and 72 and have not yet claimed Social Security. This window, enhanced by the new senior bonus deduction that expires in 2028, may genuinely never be this favorable again in your lifetime. Step 3 is exploring qualified charitable distributions if you are charitably inclined and subject to required minimum distributions. The tax efficiency of giving this way versus any other method is extraordinary. Step 4 is reviewing which state you live in and whether the tax treatment of retirement income in your state is aligned with your financial goals. And Step 5, the most important step of all, is having a specific conversation with a tax professional who specializes in retirement income, not just a general accountant, but someone who lives in this world every day and understands how these strategies interact with each other. Because the truth is, the IRS has built these tools into the tax code deliberately. They are not loopholes in the sense of being accidental or exploitative. They are policy choices that Congress made because they want retirees who plan well to keep more of what they earned. The 88% who pay nothing are not cheating. They are just paying attention. And now, so are you.